Recently, I spoke to a few friends of mine who happen to be aspiring entrepreneurs who are planning to launch new businesses next year, and were inquiring about how to promote it on social media, but without doing so on video because they don't really like that sort of thing. I told them I had the perfect solution. Start with a podcast. Now, they were a little concerned about what all went into it, so I explained to them how Spotify for podcasters makes it simple, as you can record, edit, schedule, and grow your community all from your phone or from your computer or whatever else you want to use. Plus, if they wanted to monetize it, Spotify will even go out and find them advertisers. And the craziest part is, they do all this for free. So if you're like my friends, stop wasting time, start making money today by heading over to Spotify.com/podcasters or download the Spotify for Podcasters app today. Welcome back to the Trading Coach Podcast. As always, your host Akil Stokes here. Today, we're going to talk about how time will show you the true value. We're going to talk about that in a few different aspects. Speaking of time, do me a favor, take some time to leave this podcast a rating or a review. We're consistently ranked one of the top trading podcasts out there, but I want to be the top, and I can only do that with your help. So leave me a rating or a review on whatever podcasting app you're listening to this on. That is the best way you can support the show. So today's question came from a question, I guess, that I got from a social media post that I shared, right? If you guys follow me on Twitter at Akil Stokes RTM, I do it a little bit on Instagram as well, but usually on Twitter, I like to share quotes and different infographics and pictures and stuff like that. A habit that I started very early on in my career before I was a trader, basically when I graduated college and I had no job and I was depressed, was finding something that would make me happy, finding something that would motivate me on a regular basis. So I'd spend the first 15, 30 minutes of my day. I had a little group chat with a few of my friends who were in similar situations, and we would find motivational quotes and share it with each other as kind of our pump up. And we actually started a website doing that, and that website turned into my first trading website, which turned into my first trading journal, which kind of got me into coaching as people read about how bad I was and they seemed to like it. So it's interesting, but it's something that I still do to this day, and I try to give it back so I can share with you guys. And a quote that I put out today was one from Benjamin Graham, and the quote says, "In the short run, the market is a voting machine. In the long run, it is a weighing machine." And the question that I put in the caption was, what do you think this means to me? And I got a lot of comments over the years, and one that recently came in was a question that said, well, Akil, a little confused by it. What does it mean to you? And how I interpret this quote, right? The short run is a voting machine, the long run is a weighing machine, is that I look at voting as being like a popularity vote, right? When people say, hey, vote yes or no, everyone runs right away. They don't really take time to think about stuff. They kind of just vote and do it and blah, 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 blah. A weighing machine, I interpret that as you're taking more time to actually think about your choice, meaning you're not just kind of acting right away at the first kind of boom thought that comes into your head. You're actually taking time to weigh and balance the pros and the cons of it. And from a financial perspective, I see it like this. We look at short-term moves in the market as being really emotional moves, right? So a perfect example would be like a news event. If you ever watched the market move during a high impact news event, an interest rate decision, an FOMC press conference, a non-farm payroll, something of that sort, you'll notice that as soon as the thing comes out, the market starts going crazy. Now it goes crazy to different degrees depending on kind of what the result is and whatnot. But you see the market moves, it goes up, it goes down, it goes left, and it goes right. Those are the votes coming into the market. Those are your traders, and in most cases, retail traders, panicking or doing something to get involved. The first thing that comes to their mind, ooh, I gotta buy. Ooh, I gotta sell. Ooh, I gotta do this. Ooh, I gotta do that, right? And they're not really thinking about it. And then what you typically see after it as the dust settles, and typically it starts to settle about 15 minutes afterwards, and then if you come back the next day or a few days later, you'll see that the market has done what it truly intends on doing, and that is the weighing machine. Thinking about it more specifically, right? Let's say an FOMC press conference comes out, and our Fed chair, Jerome Powell at the time, let's say he says something that is kind of different, it deviates from the expectation. Well, the market may panic. The market may go into this crazy mood of like, oh my gosh, I can't believe he said that. We're going to do this monetary policy, blah, 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 blah. And it panics. And then what happens later is as you get a chance to really sit down and rewatch the press conference and interpret what he's saying, or instead of just taking the quote that you see on Reuters, looking at the full context, you notice that, well, okay, he said it, but he actually meant this, and it didn't really mean what everyone thought he meant. And then you change your mind about the market and say, okay, we shouldn't be selling $1. Let's buy it again. Everything is what we expect it to be. And then you see these big corrections in the market, and the market going on to do what it was supposed to do. So that's what I mean when I talk about the short-term voting, or short-term voting versus long-term weighing. And when explaining this to the trader, it didn't really seem to make too much sense. The first response I got was, are you talking about lower time frames versus higher time frames? And I'm like, no, but yes, kind of, because it also kind of relates to that, right? If you spend time on the lower time frames, there's a lot more noise than on the higher time frame, right? I always say that the higher time frames are going to give you a more legit signal. So, you think about it like this. If you're watching a 5-minute chart, you get a new candlestick, a new session prints every 5 minutes, right? So the market doesn't really have time on a candle by candle basis to kind of think about anything. It's one big voting machine. It does this, it does that, it does this, it does that. The daily candle, why that is so much more important, I guess you can say, than the 5-minute candle, is because the market has an entire day to make a decision, right? Think about a higher high, higher close, or an important level of structure. We can easily break one on a 5-minute chart and then come back into it a few minutes later as the market changes its mind. The daily level of structure is a lot more powerful. So if we're going to violate that level of structure, it's a much more powerful signal because there's really going to be a battle. So although I didn't specifically mean it in the case of higher versus lower time frames, it does relate to that as well, to the specifics of your technical time frames. But being a guy of analogies, and specifically sports analogies, one of the best ways I can explain it is this. Think about a professional athlete that hasn't lived up to the standard. So think about a young phenom, whatever sport it may be, and think about this young phenom being put in a professional environment, and the first game or first match, they have an outstanding performance, right? What typically happens in the news? Oh my gosh, this youngster did this. This is the best player since blah, 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 blah. The next Michael Jordan, the next LeBron James, the next Tom Brady. This is the next Ronaldinho, whatever like that, right? And they have all this hype machine going for them just off of one performance, right? Well, over time, we're going to actually see if that player is true to that level or not. And sometimes the player does go on to kind of, fulfill all the hype. Again, LeBron James is a perfect example. He had all the hype in the world when he first came into the NBA, and he did not disappoint. But for every LeBron James, there's a player that has that initial performance, and then they can be a bust where they just get horribly bad, or maybe they're just a mediocre player. But the point is, you can't really base judgment off of a player during their first game. You can't really base judgment off of a player during their first year, right? It's all about what they do the entirety of their career. And the longer you zoom out on that perspective, the more true the facts are, right? One game, very, very small sample size, doesn't really mean much. 1 year, yeah, it means a lot more. There may be something there, much more than a game, right? 5 years, if someone's consistently doing it for 5 years, then we probably have the right idea. We were talking about this morning in the Q&A session. We had a nice conversation about money management, position sizing, and stuff like that. And we were having a conversation about probabilities, right? We're talking about like the martingale strategy and why I think it's a very, very horrible idea. I'll probably put that out as a podcast as well. I think there's one in the past too. But we were talking about how we never know the outcome of any given trade, right? If I knew the outcome of any given trade, I'd be the best trader in the world because I would never trade the ones that I knew were going to lose, and I would invest everything on the ones I knew were going to win. The point is, we never know. We can have the best setup in the world and it can fail. We can have the worst setup in the world and it can do fantastic, right? What we do know is our long-term probabilities. And when I say long-term probabilities, I mean over an extended period of time. So let's take this example, right? If we were going to say have a coin flipping kind of contest, right? Heads I win, tails you lose. That's how I got down in middle school until people figured it out. But heads I win, tails I lose. If we were to flip that coin every single day, right? We're to meet at a secret location, preferably a dark, shady alley, and flip that coin every single day, right? 365 days of the year. I can almost guarantee that by the end of the year, we would probably be close to a 50-50 win-loss, right? It could be anywhere between 45 to 55, but somewhere in that area. We would be close to having the same amount of wins as losses, right? Because there are only two outcomes to a coin flipping. And over time, we should be in that area. Now, with that being said, if this was a one-time deal, if we met one time in one dark, shady alley and flipped a coin, I have zero idea if I'm going to win or lose, right? Because the probability doesn't have a big enough sample size to really play out, right? Same goes for, the casino, right? If you go to a casino, you hit heavy on the first hand, what typically happens? Well, you hit hard on the first hand, you make a lot of money, and then by the end of the night, you're broke, right? Because the casino has the edge, and eventually everything reverts to the edge. So the longer you stay in the casino, the more likely you are to give your money back to the casino, right? This is why casinos pump fresh oxygen. This is why they have no windows, have no clocks, right? They don't want you thinking about the outside world. They want you staying there as long as possible, feeding you free drinks, because the longer you stay in there, ultimately, the more time they have to extract their edge, right? Going back to the coin flip conversation. If we were to flip that coin once and I won, does that mean I'm better than you? Well, no, not at all. It just means on that one time, right, I won the match. So that's how we think about long-term versus short-term. And as a trader, with our probabilities are based on long-term consistent execution, right? So I'm a little bit all over the place with this topic because I can go plenty other ways. This goes down so many other rabbit holes, but I hope that explains what that quote means. And we're talking about short-term voting or short-term kind of emotional action, longer-term weighing, meaning that the decision-making over the longer term will tell the true story. This is something that you want to do in your trading when it comes to the edge. This is something you also want to do in life when it comes to your decision-making, right? Don't get too kind of caught up over a short-term action or a short-term reaction or any type of short-term thing. Think big picture. And in general, that's something that we just don't do well enough. Hope that made sense for you guys. Hey, let me know what you think in the comment section below. If you're listening on Spotify, there's a little Q&A thing where you can share your thoughts. If you're watching this on YouTube, there's a comment section below as well. I'd love to hear what you think. Appreciate you guys joining me as always for the Trading Coach Podcast, and I'll see you guys next episode.